Hey everyone, welcome back to Signal or Noise, episode 5. I'm Charlie Bilello, joined as always with Peter Mallouk. And Peter, big news. We're now a podcast. Awesome. You can find us on iTunes, Google Podcasts, Spotify. So I know many of you are watching this on YouTube. If you prefer podcast, check it out there, subscribe, and give us a review. We'd much appreciate it. Peter, are you a podcast guy or a YouTube guy for the most part?
I'm a podcast guy mainly, actually, so I'm very excited about this. How about you?
Okay.
How do you consume?
Awesome. I do both. When I'm exercising or doing something where I can do both, I usually do Spotify for the podcast. But if I want to visualize something, I'm more of a visualized person than it's YouTube on my PC. So yeah, awesome to be in many different places, and thanks to the team at Creative Planning that made this possible. So here we go, Peter. Is it a new bull market? That's what everyone's talking about. But before we try to answer that question and whether that matters or not, I just want to talk about last year. What did we hear the entire year? Which is stocks are in a bear market. And they were down over 20%, and that's the technical definition. They ended up going down over 20% if we look at the S&P 500, more than that if you look at tech stocks, much more than that if you looked at the high growth tech stocks. But all of a sudden, after a 27% rally, now we're hearing the opposite. We're hearing it's a new bull market, what you should do about it, all the rest of it. When you hear these terms, bull, bear, there's a suggestion that you should do something about that. What do you tell clients? What's the way to approach these technical terms, which there seems to be many different definitions? Is there anything to do based on bull or bear market?
Well, the short answer is no. The longer answer is, I mean, this is really, to me, fascinating because if you look at about a year ago, 6 months ago, we're talking about the dollar losing its reserve status. The Fed is going to break the economy. Unemployment is going to go up. We have an inverted yield curve. That means there's going to be a bear market that's imminent. It's probably going to be prolonged. Most stocks are well off their 52-week highs over and over and over again. And you see, to your point, all of these predictions from all of these analysts and all of the major brokerage houses that, hey, probably going to be a bad year. And it's completely unpredictable. I mean, this is even when the market goes down 7%, people go, well, it's going to go down. It's going to be a correction. It's going to go down 10%. But the majority of the time, that doesn't happen. When you have a correction, which is a 10% drop, everyone goes, oh, we're on our way to a bear market, which is a 20% drop. A majority of the time, that doesn't happen. And when you're in a bear market, and we barely touched one, where the market goes down 20% or more, everyone assumes it'll be prolonged or it will continue at least for the foreseeable future. And a lot of the time, as now, that doesn't happen. So we're seeing this turnaround, and now we've got this different narrative like, hey, the bulls are back in town, pile into the markets. And really, the bulls are not completely back in town. If you look at most stocks, they're still well off their 52-week highs. What we've seen is a big tech recovery. Big tech makes up a fourth of the S&P 500. And so when we look at that S&P 500 return, it's very easy to go, oh my God, everything's turned around, everything's back. But it's really one market cap, which is large cap, and one sector, which is tech, that has really taken off. And that's the index we all look at. And so it appears that we're in a raging bull market. So look, I'm generally bullish most of the time because that's generally how markets work. But you cannot read too much into it either way. And the last 12 months is a case study.
No question. And just the concept of saying something, especially a bear market, and that's going to be helpful at the time. What I like to bring up are examples, and there's quite a few of them in the last 20, 30 years of bear markets that stopped pretty much right at 20%. So if we look at 1998, we look at the period in 2018, that was around 20%. And 1990, there was actually a recession, and there was a bear market of 20%. You look at those periods and look at the headlines at the time. We're in a bear market. We're in a bear market. Sell, sell, sell. And then exactly at that point, it starts moving higher. Now, obviously, we've had bear markets as well that have gone down over 50% in 2000 to 2002 or 2007 to 2009. But the broader point is you just don't know where it's going to end. So assuming that just because something's in a bear market and going down, that's going to continue, well, that's not very helpful. You actually want to start looking for a place to buy where sentiment goes to the opposite extreme. We'll talk about that later. But in terms of this bull market rally here, let's say it ends tomorrow and we go back down another 20%. Well, that's not going to be helpful at that point to identify that as a new bear market. It would be helpful today, but nobody can do that. So these are terms that I like to say you can only use them in hindsight. And in hindsight, there's no value to investors. So next time you hear a bull or bear market, understand that's just telling you what's happened in the past, not what's going to happen in the future. But speaking of sentiment coming into the year, Peter, this was a surprising one at the end of last year. You named all of the reasons why it was pretty easy to be bearish, from inflation to the Fed to the war in Ukraine. Any number of things were causing people. There was pretty much the most anticipated recession in history, which now has been pushed back. So analysts were pretty bearish, right? There's strategists that make these predictions every year. We seem to love these types of predictions, or at least the media does, and people always want to be told what is going to happen by a specific date. So every year there's this game that's played on Wall Street where these strategists, these are supposed to be experts, put out their target. Where is the S&P going to end the year? And last year, for the first time in a decade, they actually said stocks were going to be down this year. And what has happened so far this year? Well, one of the best starts to a year in history. And what are strategists doing today? Well, as you might imagine, they're raising their price targets. What is an investor supposed to do with this endless game of hearing targets and predictions? How are they supposed to respond to that?
Well, I wrote a whole book, The 5 Mistakes Investors Make, that basically premise number one is ignore all of this completely. Don't ignore 99% of it, literally 100% of it. If you follow analyst forecasts, you're going to wind up way worse off than if you do nothing over the long run. I mean, there's just an overwhelming mountain of evidence that makes that clear. I think people don't realize that when you're in the middle of markets, so just like if you're a regular retail investor and you're looking at your portfolio every day, people doing that are more likely to underperform, say, a physician that's really busy and looks at their portfolio once a year. And it's no different with the professionals. The professionals themselves get caught up in the minutia and the day-to-day and the mindset of where a market is. And 6 weeks can feel like 6 months, and you get caught up in that narrow narrative. And that's what their predictions are. I mean, if you look at what's happening now, it tends to be the prediction, just like you showed. Hey, things are bad. My prediction is things this year, coming year, will be bad. Things are good now. My prediction is for the next 12 months, things will be good. That's actually what happens most of the time. It's completely useless and actually
just recency
harmful.
bias, right?
Total recency bias.
Yeah. So when what I like to think about is, let's say you knew for sure where the S&P was going to end the year, but you're a long-term investor. You're investing for the next 10 or 20 years. How are you going to adjust your portfolio to take advantage of it? You knew it was going to be up 10%, which is the average return. And typically, right, that's what analysts are forecasting. 3 out of every 4 years are positive. So they're usually making the right bet. This year, they came into the year very surprisingly saying it's going to be down. What I like to say is, even if you knew for sure and you're a long-term investor, how is that changing anything? Are you going to go more aggressive, I guess, for that year and then change back? It's just, there's a lot of different variables that go into investing, and adding something so uncertain as a price target, and particularly now we have 6 months to go and they're raising these price targets, obviously because they can't leave the low price targets. They're going to look foolish, right? It's similar to the Silicon Valley Bank. It's going down, it's going down, going down.
Now we'll readjust to zero.
Right? Yeah, the day before it goes bankrupt, they're cutting the price target, but it's still well above where it ended up, which is zero. So with this stuff, it's hard. I know it's hard for everyone. I guess maybe as an entertainment thing, we like to hear these things. It's entertaining. Where is it going to go? It's market chatter, but from an investment standpoint, the worst thing you could do is follow what someone is predicting in a very short term. Not a good strategy.
Following short-term analyst sentiments is worthless. It's really, what are your goals? What asset classes match the goals? And how do I buy those the smartest way possible and get out of the day-to-day game?
Absolutely. So let's talk about winners. And there's been a number of winners that have gotten attention in recent years. And you've talked about falling in love with your winners. And I think that's an understandable thing. If something in your portfolio has produced an outsized return, you're going to be happy about that. And we've had a number of these stocks in recent years. If you look at the top six stocks in the S&P 500 right now, they're all household names, right? Apple, Microsoft, Google, Amazon, Nvidia, and Tesla. Everyone knows these names. If you look at the last 10 years, incredible returns in all of these. You're talking about thousands of percents. If you're talking about Nvidia, you're actually talking about over 12,000% in the last 10 years. That's 62% annualized. So less than every 2 years, you're doubling your money. Just an incredible run up. The problem, of course, and we touched on this the last time, but I don't think we touched on it enough. Assuming that something is in the top 10 is going to be big. There was a great study that DFA did on this. Assuming that those enormous returns are going to continue hasn't been a very good bet. It might continue for a little bit. If you're looking out 10 years, you actually see underperformance in these names after joining the largest 10 stocks. And there's probably a number of reasons for that. Once you get big, it's hard to get bigger. It's hard to produce the same growth rates, right? You have just a bigger organization to manage. Perhaps that's not, not a competitive advantage. There's a lot of different reasons, but when someone comes to you and says, Peter, I've done extremely well in this particular name, whether it was luck or skill, doesn't matter, and they're telling you their expectations for the future, how do you bring them down in terms of using the data?
I mean, this happens actually all the time, and it makes sense. So, like, if you take the S&P 500, there's a lot of indexes, but let's just stick with that. Yeah, there's 500 stocks, but there are always only a few just off-the-charts crazy winners. And the advantage of owning the S&P 500 is you get that needle in the haystack. It lifts up the market returns. We're seeing that this year, right? Most of the market returns, the S&P 500, are coming from
unusual year. That tends to happen, but even this year, it's way more concentrated than it usually is.
Yeah, this is even crazier than normal. Now, what happens is that obviously a disproportionate amount of people make wealth in those stocks, right? And so you have a lot of people that work at those companies or happen to buy those stocks. You don't have the people that own the other 490 stocks saying, I want to keep all my money in this stock. But if you had all your money in one of these, off the charts companies, it's very hard to say, hey, look, this has worked. I can give you the statistics that this probably won't work. And they go, well, yeah, but if you would have told me that a year ago or 2 years ago or 3 years ago, it kept working, right? Because you're dealing with the outlier on the curve. So it's very hard to talk to somebody like that. And I mean, I had somebody who was at Boeing, and Boeing had done incredible for a long period of time. And 6 months later, they had a couple of crashes, right? I call them incidents, actual crashes, and it was actually a question of if the company would go bankrupt. It's incomprehensible to some people that things can change, and there's two things that can change. One is it's harder for these huge companies to double, which is, I think, a very big factor here. Obviously, the company that's going to go up 1,000% in the next couple of years, there are some of those companies. It's probably not the top 5 or 10 companies. It's probably other companies in the S&P 500 or another index. And also, things can change very, very fast in a capitalist environment. Laws, regulatory risk, a competitor comes out of nowhere and just completely changes the game. And I think that all of those things conspire to control those off-the-charts winners from doing it again for another decade.
So is the best thing to say to a person like that, and this is what I like to say, how would you feel if you lost those gains? Because we know the feeling of loss is way worse than the great feeling that you get when things are going up. And is the right answer, well, if you at least diversified and took some off here, and unfortunately you might have to pay some tax in doing so depending on where you're holding that. If you do that, well, that's going to minimize the pain if it goes down. But if it continues to go up, at least you still have some exposure to that, and you won't feel that regret of, oh gosh, I should have held on to. Because in reality, yes, we know that the data suggests if you have that huge winner, sell it, put it in an index fund, diversify. But emotionally, for that person, if Nvidia goes from being a $1 trillion company to $5 trillion in the next few years, it may be very unlikely. But if that were to happen, that person's going to be extremely upset. But to me, they'd be way more upset if it goes back down to, let's say, 100 billion, right, from a trillion, which
it's usually a no-win situation, right? If you diversify and the stock keeps going up, you have regret. If you stay in it and the stock goes down, you have regret. I mean, the only way you don't have regret is if you diversify and the stock immediately goes down and the market goes up. I mean, that's a very perfect combination that happens. So there's always going to be some negative emotion associated with diversifying away from a very, very big position. And the way I like to talk about clients today is if you showed up today with all the money you had, let's say it's $2 million, and I said, I want you to put all of it in this one stock, what would you say? Right? And they almost always say, well, I wouldn't do that. Well, that's the decision you're making when you're staying in the stock. I mean, you can, with a click of a button, make a change. You're making the decision to rebuy that stock that morning and have all your eggs in that one basket.
Yeah, and I think especially for people working at companies, and if they didn't learn it, they should go back and look at all the tech high flyers in 2020, 2021, where they had incredible gains. They worked at these companies, and like you said, they didn't foresee things changing, whether it's Peloton or Zoom, and they have all of this money in the stock. They made windfall profits, but they didn't think that anything was going to change, so they left it all in these companies. And just to see the downside of that is heartbreaking for people. You have the extreme, of course, if you worked at Silicon Valley Bank or First Republic and you own stock and that goes to zero, right? They're essentially wiped out. But a good lesson for people: don't assume just because you work at a company you know everything about it, that it's going to necessarily not only go up, but it's going to outperform. So you're betting that that company you work at, which you already are invested in terms of your career and your income, now you're betting it's also going to outperform either the NASDAQ 100 if it's a tech company or the S&P 500. And that's we know that that's a hard bet to make, but I think emotionally for people, it's hard for them to understand that just because you're working at a company, you see things going on, you don't have necessarily that edge or inside information that this company is going to do better than a broad index. And so it's not an easy game, Peter. And like you said, I don't think there's a perfect way to approach it. I think it's based on your personality and how much you'll be disappointed if it goes down versus selling it all going up.
Yeah.
So
it doesn't need to be all or it doesn't need to be all or none,
doesn't
right?
need to be all or none.
Yeah, do what you need to do to get to a safe place.
Yeah. So let's talk about chasing the past here. And in 2020, I'm sure you got a number of people asking about this particular vehicle, the ARK Innovation ETF. And why were people asking you about it? Because it was going bananas to the upside, over 150% return, one of the best performing runs for an ETF or fund ever. Got a lot of attention. If you compared it at the time of its peak in early 2021 versus the NASDAQ 100, it was way ahead of it, right? And then we saw this inevitable, which many of us talked about was going to happen, but nobody wanted to believe it's going to happen. This is a reversion to the mean where it's down in 2021, 2022, 75%. I think peak to trough, it actually went down a little over 80% from that February 2021 peak. And first, were people asking you about it? And what do you do in general when they're asking about this hot manager or hot sector or hot product? There's always one that's out there today. It's obviously AI, ETFs, or anything related to that. How do you talk people down from chasing the past in terms of performance?
There's always something. And I remember for a long, long period of time, it was Legg Mason Value, which Bill Miller was the only mutual fund manager, I think, in history to beat the S&P 500 15 years in a row. And so it became this, well, of course someone can beat it. He's proof. And so a bunch of money flooded into that. And of course, then it had its worst year ever. Bet big on things like Fannie and Freddie that went to zero, just completely collapsed, and wiping out the people that had invested in it. And ARK's very similar. And here's what I think is not, you don't see it in the chart, and that's that this is much worse than it appears. So when Legg Mason Value was really getting going, there wasn't anybody in it. When ARK was posting those big returns that drew the capital to it, there were very few investors in it. Most of the money actually went in during the year where it topped, meaning that the majority of investors, their experience is just devastating losses. Only the minority underperformed. The minority were in from the beginning or near the beginning and then went up and then collapsed and just underperformed. Most people got smashed because they came in at the top. And that to me is the real conversation behind these charts is when you see that anomaly on the upside, there's probably the downside coming, but the capital, don't be attracted at that time because that's when the capital gets attracted to these things, and it's usually just in time to experience the other side of the story.
Yeah, I think I saw a stat. It was, I don't remember the exact amount, but the dollar investor dollar gained or loss from ARK from inception in 2014 was negative and highly negative because of what you said. Most of the money came in late 2020, early 2021, when you had the most extreme performance. There's FOMO. All your neighbors are talking about. Everyone's talking about. You don't want to miss out on these stocks. I wrote a piece, I think the day actually, that was just lucky timing, that it peaked in early 2021 about that investor sentiment about this portfolio at the time. There was a median price to sales ratio of the holdings and ARKs at that time was over 30, the median, which is an unbelievable collection of high expectations. And so naturally, those expectations didn't last. That median price of sales has come way down, now below 10 times sales. We could debate whether that's rich or expensive, but back then there was almost no debate. And ARK is not alone. There's no reason to believe that's anything different because we have the data on it. The S&P Dow Jones does this persistence of performance that they put out, this report, and what they showed of all the equity funds that existed in 2018. If you looked at the top quartile funds, so the best performing funds as of that year, and you fast forward to the end of 2022, exactly zero were still in the top quartile funds, which is incredible to me because we don't believe that. We like to believe that there's some skill involved, and that if someone's doing well, that skill will continue. And really, the difficult thing for us to do as investors, which makes it much harder beyond the mean reversion, is disentangle skill from luck. And we talked about Bill Miller, and he was great manager, a lot of expertise, a lot of knowledge, but nobody knows. If you're talking about thousands of funds, someone was bound to flip that coin heads 15 times in a row. Now, we don't know. Maybe that wasn't the case. Maybe there was actual skill there, but we can't tell definitively, right? Just like they did studies of monkeys throwing darts who did better than the average fund manager. You just don't know what's skill and what's luck. And then by the time you're assuming it's skill and then it mean reverts and comes down, well, now what do? Was ARK skill on the way up, or was it just in the right sector during a mania? Is there actual skill here? Do you have to wait 20 years to find out? Should you be doing that? It's a very difficult game to play, trying to not only pick a manager who has expertise, but find that manager at the right time.
Yeah, and I think that this is it's hard for people to understand because most people that are investors, a small percentage of the population is investing in the stock market, and these tend to be more successful people, and they're probably more successful in their jobs than their peers, no matter what they're doing, whether they're an electrician or a doctor or a lawyer. If you're investing a lot, you're probably more successful than your peers. So it makes sense. You would think, I'm going to go into this space and I'm going to find people more successful than their peers. The stock market just doesn't work that way. If you have 10 musicians and one of them's Taylor Swift, I'm going to bet Taylor Swift's going to sell more albums on her next release than somebody else. It's pretty safe bet. Past performance is indicative of future results. The difference here, it's a fixed pie game. Everyone's trading the same stocks. Someone sells 1 million shares of McDonald's. Somebody's buying 1 million shares. Everyone has the same information. Too many smart people trading in real time. And what you get over time is underperformance. And by the way, this underperformance is before you account for taxes. So it's actually worse than it appears to be.
Sure,
when you see activity, all of these funds lagged out.
Yeah, no question. It's very hard because people watch sports and they see good teams that win, continue to win. As you said, in music, we see this in many different areas. If you need a surgery and you're looking for a good doctor, you want one that has a good track record. You're assuming that's going to continue in the future, and that makes sense, but not so in the financial markets. And just coming back to that point, why is stock picking so hard? Well, the average stock does way better than the median stock, and simply only 24% of stocks over the last 20 years outperform the average stock. So if you have a concentrated portfolio, which you need to do, right, in order to have that ARK performance on the upside, you have to be concentrated, right? And so it was a good thing. We could say whether that's luck or skill, but it was a good thing to be concentrated at the time. But now missing out, I think I heard that they had sold NVIDIA, and now they don't have NVIDIA, and that's why they've lagged, a little bit, I guess. not having that now is hurting them. And the more concentrated a portfolio is, the more likely you are to not own those big winners, which we can't unfortunately identify in advance. So
And
let's
most
end
people
with
most people don't understand this concept. They think, oh, well, half underperform, half outperform, and so my odds are pretty good. All I got to do is a little bit better, and that's just to your point, not how it is at all. Most underperform. The ones that outperform, what's good about them is there's no limit, right? If you go down, you can only go down 100%. If you're a winner, you can go up 1,000%, as we saw, with your first charts with big tech. And that's the key. The more you concentrate, the more likely you are to get that big winner. But the odds are against you overall because most stocks are going to underperform. And I think that's the starting point where people don't think about investing right. I mean, they think, oh, 50-50, not how it is at all. And that's why it's so hard to come out ahead.
right. If you're going to do it, set your expectations very low that you're going to be able to outperform, right?
Yeah.
Do it with a very small percentage of your portfolio, and where to the point where it won't hurt you. So, signal or noise, Peter, we're going to keep it simple today and just talk about sentiment. And sentiment's measured in many different ways, but there's this poll AAII puts out every week. They poll investors. Are you bullish or bearish on the U.S. stock market over the next 6 months? When you hear this poll reported or anything similar to that, does it get your attention at all? Is there any signal to sentiment data?
Only when it's extreme, and even then I completely ignore it. I mean, there's some indication that when it's extreme it might mean something, but usually contrarian. But in general, I view all of this as noise.
Right. And the extreme point, I would agree with, when it's not usually at extremes, so most of the time just ignore it. But last year, September, October, we saw one of the lowest readings ever for this index. Got my attention. It had only been lower in 08, 09 and back in 1990 during the recession back there. And what I said at the time, similar to Warren Buffett, right? If you're gonna try to time the market, and you shouldn't, you should try to be fearful when others are greedy and greedy when others are fearful. And so last September, October, pretty good amount of fear. So contradicts the Gordon Gekko, one of my favorite movies, in Wall Street. Greed is good. Greed is not good for investors. Fear is good because fear creates opportunity. And what we saw last September, October was an extreme amount of fear. And what I showed is this table at the time saying, if you have that extreme fear, so bears are outnumbering bulls by a huge amount, so lowest 3% of readings, you tend to have above average performance going forward. It's not guaranteed. It's nowhere near 100%. And the opposite, when you have extreme greed, which is pretty rare, you tend to see below average returns going forward. Now, can you use that to time the market? Absolutely not. But if you have extra money to invest, it's long-term money, similar to markets in turmoil indicator. There's worse things you can use than extreme sentiment to the downside.
Right, and part of that is just you get that really bad reading when the market's way down. When the market's 20%, then people's fear gets heightened. And we know when the market's down 20%, its expected return over the next 3 years is 14% a year. Over 5 years, it's 11% a year, above average, right? So yeah, it's not so much people are scared the market goes up. It's the market is way down. That is why people are scared. When the market's way down, the expected return going forward is a little bit better, and it just plays out over and over and over again that way.
Yeah, so sentiment is just a reflection of price. Prices have gone down. They're discounted. Stocks are perhaps cheaper. They tend to do a little bit better when they're cheaper. And it's interesting, though, to me, with sentiment, it's the exact opposite of how people behave with retail. On Black Friday every year, people are fighting each other to get into the stores to buy these items at a discount. But in the stock market, when it goes down, they're running for the exits, so to speak. So very different. Obviously shows you emotions are a big part of the stock market. And if you can control those emotions, you're going to be way better off than most people. So Peter covered a lot of ground there. I'll end it right there. For more content like this, subscribe to the channel. Again, we're available on all the podcast platforms as well. Thanks everyone for joining us, and we'll see you next time on Signal or Noise.